Picture this. You've taken a job overseas, the foreign tax comes out of your pay automatically, and you assume Australia is completely done with you. It's the most natural assumption in the world, and if you've made it, you're in very good company. But here's the thing, most people never get told. If the ATO still treats you as an Australian tax resident, your worldwide income can be taxed right here too. Stick with me because by the end I'm going to show you exactly how to check your status and lodge correctly, and it's simpler than it sounds. This isn't a small paperwork detail. It decides how much of your money you actually keep. According to Country Tax Calc and Expatica, for 2025 to 2026, you'll be taxed as a resident on your worldwide income at rates from 0 to 45%, plus the 2% Medicare levy. But if you're a non-resident, you get no tax-free threshold at all. You pay 32.5% from your very first dollar of Australian source income. So if you've assumed your foreign income just sits outside your Australian return, that one assumption could leave you underpaying and facing an ATO adjustment later, or worse, paying tax twice on the same money. Get this one category right and honestly, the rest of your return falls into place. And here's the number it all hinges on. Here's the figure this whole topic turns on. According to Country Tax Calc and Expatica, the $18,200 tax-free threshold is yours if you're an Australian resident in 2025 to 2026. But if you're a non-resident, you don't get a cent of it. Let me put that in real terms for you. If you're on the lower end, earning around $30,000 overseas, that threshold alone saves you thousands. If you're in the middle, say $60,000, the gap between resident and non-resident treatment widens fast. And if you're a high earner closer to $100,000, misclassifying yourself could cost you well over $10,000. So whether you're a resident or non-resident isn't just a label. It's real money in your pocket. So let's start with step 1 because everything else depends on it. Nailing down your residency. Head to the ATO residency guidance and write down your facts honestly. Do you still have a home here? A spouse in Australia? Ongoing ties? How long have you actually been overseas? And do you earn any Australian source income? Then match those facts to the resident and non-resident tests. According to Country Tax Calc and Expatica, getting the right category matters enormously. Resident means your worldwide income is in play. Non-resident means mainly your Australian source income. Write your result down clearly before you lodge anything, because if you're not sure, that's completely normal, and this one step removes all the guesswork. Step 2 is about building your evidence for the foreign income tax offset, and I want to be upfront with you here, because this is where it takes a bit of real effort. Find the ATO's FITO guidance and list every foreign income item that had tax withheld or paid, your salary, dividends, rent, pensions. Then collect the proof. Foreign payslips, foreign tax assessments, and withholding statements. And here's the honest catch. The ATO says you can only claim the offset if you actually paid or are deemed to have paid foreign income tax, and you include that income in your Australian return. No evidence, no offset. It's that simple, so if you keep everything organized now, you'll thank yourself at lodgement time. But hold on, because the next step is the one people get wrong most often. Step 3 is conversion, and this is where people slip up constantly. The ATO requires you to convert all your foreign income into Australian dollars before you calculate your net income. That means your salary, your dividends, your rent, and importantly, the foreign tax you paid all need to be in AUD. Keep a clear record of the exchange rate basis you used so your figures are consistent and you can defend them if the ATO ever asks. What good looks like is every foreign figure reported in dollars with your conversion method written down. Do that and you've done the hard part. Now here's an important limit on the foreign income tax offset that most people miss. The ATO says the offset only goes up to the amount of Australian tax payable on that same foreign income, so if your overseas tax rate was higher than ours, you won't get the full amount back here in Australia. The offset simply stops you being taxed twice on the same income up to the Australian level. Knowing this upfront means you won't be surprised by your final figure, and it's exactly why the next mistake is so costly. This is the single most expensive myth I see, so let me clear it up for you. Most people believe that because they paid tax overseas, they don't need to report that income in Australia at all. According to the ATO, that's simply wrong. Your foreign income may still need to be included in your Australian return, and relief only comes through the foreign income tax offset once the rules are satisfied. If you just leave the income off, you're risking an ATO adjustment down the track. And here's what makes it worse. If you've got a recurring overseas salary, that same mistake quietly repeats itself every single year until someone catches it. The second common slip-up is mishandling the offset or the currency conversion. The ATO warns that if you leave the offset off or you misconvert your foreign income, you can end up paying Australian tax on money that was already taxed overseas, or underpaying and facing a correction later. Neither is fun, and don't forget the timing, because this one catches people out. According to Country Tax Calc and Expatica, if you lodge without a tax agent, you're generally facing the standard return deadline of the 31st of October each year, so put that date in your calendar right now, because a missed deadline undoes all your careful work. Let's run through your plan quickly so it's locked in. Step 1. Check your residency status against the ATO test and write down the result. Step 2. Gather your foreign tax evidence so you can claim the foreign income tax offset. And Step 3. Convert every foreign figure into Australian dollars and document exactly how you did it. Remember, if you're a resident, you get that $18,200 threshold, and if you're a non-resident, you don't. And if you're self-lodging, your deadline is generally the 31st of October. 3 steps, and you're in control of the whole thing. If you've made it this far, you now understand something most Australians working overseas genuinely don't: how residency and foreign income actually fit together on your return. Your next step is simple. Open the ATO residency guidance and write down your status today, and it'll take you about 10 minutes. If you want to go deeper, next we're breaking down exactly how the foreign income tax offset gets calculated, step by step, with a worked example. And always recheck the current thresholds against the ATO before you lodge, because they can shift each financial year. I'm Sophie. I'll see you in the next one.